Hey guys, Wyatt here, the Coastal Agent. Hey, I wanted to share with you, a lot of concerns that I'm seeing out there are, the market is definitely transitioning. Are we going to experience a downturn in the market like we did in 2008? So I wanted to share with you some similarities because we are seeing them in this market compared to that market, and then also some of the differences so that we can draw a conclusion based on those numbers. So what are we waiting for, guys? Let's jump in. Okay, starting with some of the similarities, obviously right now we're experiencing the increase in interest rates, similar to the last market of 2005 and 2006. If you look at this graph here, they're about 7%, so very similar in both markets. And then that's obviously bringing us into the next one, which is the increased inventory levels. Because buyers just can't afford it anymore, that demand is starting to subside, and so inventory levels are going to increase. But looking at this chart here, even through that peak of the last market of 2003, 4, and 5 into 2006, we were well above 4-month supply, which is still a seller's market. But our market here that we're experiencing in this current market, we were at 1-month supply, in that strong vortex up. Right now we're a little bit over 2-month supply. I just don't see us getting into the, in that 2008 realm where we're like at 8-month supply. I'll get into that in a little bit. So I also wanted to talk to you about the differences in this market. If you look at this graph here, the amount of equity is almost double what we were at in the last peak. So that's showing signs that there's a lot of equity in this market. Really, it's not going to force those sales, which is what caused the last market to tank. People just didn't have the equity; they were walking away from their properties. The other difference here is the amount of cash that there is in the market right now. Last market it was about 5%, so heavily financed market. In this market right now, we're seeing 20% countywide in San Diego. So a lot of those, are all cash. They're just not going to need to sell. If they can't sell it, they'll just put it back on the market as a rental if it's an investment, or they just stay in the house. The other thing is on the financing side. These adjustable rate mortgages are starting to come back now, so a little bit of a similarity, but nowhere near that what they were before. The adjustable rate mortgages, they comprised 35% in the last market of all financing. In this market, it's 5%, so it's only 7 times less than what it was before. And then on that note is the underwriting guidelines. Looking at this chart here, kind of what caused that subprime mortgage debacle that we experienced going into 2008. That index was well over 800. The lower on that index level, the tighter the underwriting guidelines are. And it's pretty much stayed at around that 100 on the index level since 2008. So that's showing signs that the underwriters are doing their diligence, making sure that those buyers are qualifying for those loans. So we're not going to have this default rate that we were experiencing before. And again, like I was saying, that would have caused a huge glutton of inventory to come on the market. So I just don't see those levels of inventory coming on. Definitely we're experiencing more, where the buyer has the ability to get an opportunity. They're no doubt paying more per month. Their price is a little bit lower, so they're hoping that they'll be able to get that interest rate refinanced once this recession comes about and we have lower interest rates. Obviously I don't have a crystal ball. These are just the numbers and facts that I'm looking at. If you guys want to have a conversation, feel free to reach out to me. We can talk about your specific, desires, whether it be selling or buying. I'm happy to talk with you. 619-200-3236 or on the web at sdcoastalagent.com. Guys, as always, thanks for tuning in. Make it a great day.